Soft data has been incredibly misleading. If you listen to consumers or businesses at any point in the last 4 years, 3 years since 2022, and said, when they speak, you should listen, you would have been led completely astray on investment returns and risk assets broadly.
If we look at the ADP versus the BLS numbers, specifically around healthcare, like we have that 600,000 worker gap, and that's a historic wide. It's super bizarre.
I do think we're just in the midst of this massive institutional decay of trust. And now that it's starting to hit some sort of foundational blocks in the economic system, like, say, payroll data that we come to rely on.
That's fascinating as a narrative. At a time when the companies that you are relying upon to be that higher quality source of free cash flow margins and return on invested capital are all absolutely obliterating their free cash flow margins and their return on invested capital by accelerating CapEx.
Those other podcasts, they're clickbait, but this is clickbait right here on excess returns. Ground rules: 1, before we start, the group of us agree on a pre-discussed topic. 2, while we're live, nobody Googles nothing. 3, we each bring a surprise topic to the table. The mission is simple. If we as professionals have to talk to everyday people in the real world every day, shouldn't we also share what we're saying somewhere in public behind the scenes? Probably not. What do we have to lose? As Operation Ivy once said, all I know is that I don't know nothing, and we proudly concur. Let's click some beta. Who's with me today? None other than the right said Fred of supporting an independent Fed. He's too sexy for his slacks, and that's labor market slacks, I hope. All head over heels without ever exclusively being logic over feels. Let's trade some fears for tears already. Mr. Dave Nadig.
All right, that was very good. Now I'm going to have, I'm too sexy for my bald head in my head all day. Thank you for not.
That's how I want to send you to Future Proof next week. And lest we forget, the Atticus Ross to this Trent Reznor that I just introduced. The Fleetwood miggity Mac Daddy of breaking down the Fed rumor mill, the person I call when I need to tease apart Taylor rules from Taylor's versions. And to that YouTube commenter out there, this host is only whelmed when she's on vacation in Europe. It's Cameron Dawson.
I just saw 9 Inch Nails this week. That's perfect. You did.
In Boston.
We were all there.
Yeah. So you both saw. I did not.
Were you in Boston?
No, in New York.
Oh, I saw them in Boston. I'm sure they were almost as good as they were in Boston.
They probably can't be nearly as good as they are in Boston, but yeah.
So it lives up, both of you, positive reviews to 9 Inch Nails before we dive into our
top 5.
Yes.
Top 5.
This was going to be my random topic and come up with a new one. But the 2-stage version of things they played on 2 stages was amazing. And Trent Reznor is in an epic era right now. So,
easily
big fan.
He's living his best life. For sure.
All right. We might mash together topics later just to drill further into both the 2-stage experience and whatever else. I'm very curious. All right. Market related first. Not the boring topic, but kind of a boring topic, but a really important one. Who do you friggin' trust anymore? I am having some downright existential problems answering questions from clients and others between the BLS data, between this stuff with Fed governors and Fed chairs. I thought trust was at a low a year ago. And it feels like we are breaking new levels of just I don't know what to do anymore. I mean, Dave, where are you at on this topic?
I've been writing about this for the last couple of years. I do think we're just in the midst of this massive institutional decay of trust. And now that it's starting to hit some sort of foundational blocks in the economic system, like, say, payroll data that we come to rely on, which we just had this morning as we're recording this. And again, everybody's sort of I guess we sort of trust it, but we kind of fired the person who was in charge of it. And it sort of looks like it's on trend to what they were doing before. And actually, they adjusted it down even more. So you have no idea right now who you actually should trust about the data. And what I'm hearing, and Cam, I'd love to get your sense of this. What I'm hearing from other economist-ish friends, I'm not an economist, but I have economist friends, is they're kind of just turning the eye of Sauron towards private data. They're going to Haver Analytics or whoever it is, just go buy the third-party data that you can buy wherever it is, whether it's China Beige Book for your stuff out of China, whether it's, various people for local stuff. What's your take, Cameron? Are you starting to lean or look at the private data more or less skeptically than you are the public data, quote unquote?
It, well, in some ways, I think we have to be careful with private data because it's a little bit like the old parable of the people touching an elephant in a dark room, where private data is usually, by definition, more narrow than the public data sources. And so, if you rely just on one piece of private data, it can tell you a story that can be extraordinarily misleading versus what you're getting from broad aggregate data. But at the same time, I one of the key parts of our thesis over the last few years, which we called the strange landing, which is inspired by Heinlein, the idea of stranger in a strange landing, that the relationships between classic indicator economic kinds of data points and what they mean for markets had completely broken down post-pandemic, which meant that, when we think about trusting the data, there's two different kinds of trusting the data. It's trusting the data from a data integrity side of things of do you actually believe the data that you're seeing? And then what are the implications of the data that you are seeing and how you actually use it? Because are you trusting it to make investment decisions? And then that gets us into really interesting conversations about then what do we use to make investment decisions? Because soft data has been incredibly misleading. If you listen to consumers or businesses at any point in the last 4 years, 3 years since 2022 and said, when they speak, you should listen, you would have been led completely astray on investment returns and risk assets broadly, not just in the US, but broadly, kind of around the globe. And so then who do you trust? What do you look at? And my argument, and I'll pause here after this, is that we should use the market itself to tell us where the market thinks we're going by looking at intermarket relationships. So one of the ones we use a lot is things like equal weight discretionary versus staples. However, and talking myself further into a hole, I wonder if that's even becoming less reliable or trustworthy because of passive flows. How much can you trust the market to discern the difference and give you a signal between one section and another if everybody's just buying SPY and hitting the beach? So I don't know.
Well, and then there's the is good news or is good news bad news problem, which is a separate issue, right? I mean, we ran into that like in every crisis or bubble period in my life. We've run into this wall of, well, wait a minute, we just had a bad earnings print, so that means the Fed will cut, so things will go up, or like those multivariate calculuses on just the broad is this bullish or bearish kind of narrative that everybody likes to put at the top of a newspaper. That is no longer, that's itself become disconnected, which means if the underlying data is wrong, well, then we really got nothing, because I think we've already had a bit of that flip where what's more important for the numbers now is the policy response, not the actual economy. And that's a thing that happens frequently, but it feels like we're in one of those cycles now too.
Yeah, I mean, the only time, if you look back really since the GFC, where bad news was more sustainably good news was, I believe, during the taper tantrum in the 2013 timeframe. Because that was a scenario where you had put so much liquidity into the system that anything that could suggest that the Fed was moving away from that kind of support was not welcomed. But what's interesting is that as you got those bad news data prints, you still were seeing really robust earnings growth. And we keep saying, it's like the Carville quote is, it's the economy stupid, it's earnings stupid. So when we think, I come at bad news, good news, bad news very simply, which is that if the bad news causes you to reassess and recalibrate your earnings estimates, then it's not good news. If the bad news says, oh, okay, well, yeah, it's a little bit weaker, but maybe I get a few cuts around the margin, but my earnings estimates still look pretty okay, then it's good news.
But then how come we didn't get a giant reaction when half of Wall Street canceled, guidance?
Because they didn't cancel it long enough. They only canceled it for we paused it for a quarter, and most of them took the bigger write-offs, put them on books, and now we're seeing those come off, right? Do you see
So
something
that was
similar
it.
to this?
So we got 3 days of reaction in April.
We didn't get multiple, but we didn't get back-to-back quarters. I kept saying to people, like, if you get back-to-back quarters for this, we have problems. But we have a quarter and change.
But 12-month forward earnings estimates are still making record highs.
Right.
That's it. I think, like, if you know, in the realm of Einstein, make things as simple as possible, but not simpler. I think the simple as possible is just if 12-month forward earnings estimates are making new all-time highs, you're likely in a good environment for risk assets.
And I think, so I'm so happy you're saying this, and you're both saying this to a degree, to like looking at markets as like drawing, not that the markets are going to be right about this, but inferring from it. Because one of the things that's been driving me crazy is, and now there's a bunch of data around this that's making me even more crazy. Eric Pachman, have you seen this work? Bank Creek Capital? I will send this to you afterwards. We just interviewed Eric the other week, and he had some crazy data on the labor stats for this. Kyle has been writing about this too, Kyle Scanlon. So like, if we look at the ADP versus the BLS numbers, specifically around healthcare, like we have that 600,000 worker gap, and that's a historic wide. It's super bizarre. And the thing where you worry about that is you worry about where we're adding jobs and what that means for consumption, for the economy, and for recessions and whatever else. But if the markets are telling you, the markets are shrugging this off, if the forward earnings estimates are saying like that gap doesn't really matter as much, like we have to remind ourselves to take a step back from that.
Right.
That feels crazy. What is that?
Well, you know, it's like the old adage in the market's not the economy. But what's interesting is that I think actually in this moment, the market has become more of the economy because how much of the economy is being driven by AI-related CapEx. Because Neil Dutta put that chart out in the second quarter that showed the contribution to GDP from AI-related infrastructure spending and software spending was actually higher than the U.S. consumer. So even though the U.S. consumer is 66% of the U.S. economy, the degree of growth and the contribution to GDP was larger from this small cohort. And usually that only happens during times of recession when the consumer is really pulling back. So what's interesting is how much of the economy is really geared towards this very narrow source of growth in AI-related CapEx, just as the equity market is geared toward this very narrow source of earnings for AI-related CapEx. I mean, here's a wild stat. If you look at the 12-month forward earnings estimates for the Russell 1000 growth versus Russell 1000 value, since the peak in 2022, post-pandemic peak, you have Russell 1000 growth earnings are up about 30%, like 27%, something like that. Russell 1000 value earnings are flat. So, you know, you have this scenario where because Russell 1000 growth is 55% Mag 7, unless you're in this very narrow. What is it?
But isn't that, if it screams bubble, what I keep thinking of is I'm calling this the NVIDIA effect personally, where we have to look at the size of the thing in the portfolio in the pie and say, what is the size of this thing? And then what is the marginal impact it has on the rest of the portfolio? And it's crazy to hear that, especially with effectively an earnings recession in value versus growth in the Russell. And we see it in market cap in the S&P 500. And we see it in places like labor too, where you have a disproportion of the economy is based on labor growth out of sectors that are like maintenance economy jobs. And who knows what happens. Right. And it almost feels like bubbles at multiple levels in that sense, but nothing.
So is it bubbles all the way down?
It's bubbles all the way down. But back to the initial question of who do you trust? Like the one answer I'm hearing is we kind of be silly not to trust the market to some extent, right? Because it's telling us things that have been more accurate.
We trust.
Right.
Yeah.
So in NYSE we trust, I guess, but that doesn't fill me with a lot of joy.
No.
Are there individual companies or sectors that you're feeling are more trustworthy now than others? Like I have a really hard, I'll give you an example. We're talking about the AI CapEx thing, right? I think, and most people who pay any attention to this understand that there's sort of a funding bubble inherent in this, right? That every dollar being spent on an NVIDIA card is not being funded by a dollar of consumer earnings that's feeding that. We are in this CapEx process, which means somebody is spending way ahead of the potential earnings here. And that's obviously funded by private equity and venture capital, and also the big stocks at the top, like a Microsoft, making a lot of purchases of things directly. We saw that in NVIDIA's own earnings, like a massive dependency on two buyers for all of their growth. That strikes me as really fragile, right? That doesn't strike me as a sustainable thing. So do we trust that that is somehow an engine that's going to keep running? Do we trust the numbers coming out of Microsoft and NVIDIA and Apple and Google about these things?
Cameron, you've written about profit margins lately.
Yeah, can I actually? Well, I was darn it. This was going to be my other hot take, but let me. I'm just going to use.
Well, go ahead.
No. I'll come up with another one. First, we have Trent that we've already done that. Then now this one. So anywho, so I think it's fascinating that at a moment when the S&P 500 is trading at 22 and a half times forward, and let's just say we get to 7,000 by the end of 2025. That would mean that with $300 a share in 2026 earnings, you're trading at 23.3 times forward. That would be higher than we were at the pandemic peak in 2020. And of course, remember the pandemic peak in 2020 was because earnings were depressed, and you actually grew earnings by 75% over the course of the next 18 months. So you were in an environment where, yes, I'll pay 23 times because I'm getting, big earnings growth coming out of a low base. So we don't think earnings will grow 75% over the next 18 months. But let's take then this narrative that comes out of a 23 times forward earnings multiple that says, well, we should be paying more because look at the quality of the indices. Look at how high the free cash flow margins are. Look at how high the return on invested capital is. All of these businesses are far better. Why are we comparing the US equity market today with all of these behemoth cash generating machines to the US equity market of 2000, which had big weights to GE and Exxon and all of these things? So that's fascinating as a narrative at a time when the companies that you are relying upon to be that higher quality source of free cash flow margins and return on invested capital are all absolutely obliterating their free cash flow margins and their return on invested capital by accelerating CapEx that's not a one-time spend. This is a continuous CapEx spend that they are going to have to maintain all of the stuff that they've put in the ground, that you're starting to see them take this cash and invested in ways that still have somewhat questionable returns, potentially. Maybe not. Maybe there's great returns on the other side. But I think it's fascinating that you have, and what we've been saying is that effectively you have near monopoly businesses with massive return on invested capital transmuting themselves into, and they were capital light businesses, transmuted themselves into capital intensive businesses in markets that are inherently more competitive than the monopoly businesses that they were in. So you're going from higher ROIC to lower ROIC in a world where everybody's using those higher ROICs to justify broader market valuations. Speech over.
Yeah. I think that feels very true. I also think that your point on competition, I think, is a really critical one. That look, the AI folks that I talk to who like really live in this every single day and are spending real money and millions of dollars of VC on stuff, most of them have a pretty winner take all mentality about this. That at some point Google or OpenAI or Meta or somebody is going to have a breakthrough that is difficult to mirror economically for somebody. And that gap is going to cause massive depreciation on all those physical plants that have been built. Because, I mean, if you just imagine a world where, OpenAI comes out with GPT 7.5, and it is enough of a leap that it takes 3 years for Google to catch up in their development. I mean, that's a business killer at that point, right? Because all of the actual positive business activity from the availability of AI will just move towards the winner in the model race. And I think it's really difficult to create a case where all of these folks win, right? Where Meta can justify their spend and Google can justify their spend and Apple can justify their spend and Microsoft can justify their spend because they've all won the AI war. That's just that. I don't trust that one.
But it feels like that's where we're going.
About the things we've been through. The winner takes it all. Come on, guys. ABBA.
Yes, you get bring in the ABBA. Bring in the ABBA.
Bring the ABBA.
The dead look on your faces. like, why?
The switch I wasn't ready for. I was thinking about AI, and then you shifted to music. Takes me a minute. I'm not
okay if it takes.
you are. I'm old.
But correct me on this with the margin story, Cameron. Like somebody has to get to that winner take all status. Like that's the game that they're all playing right now until they're playing a different game at some point in the future, because the size of this CapEx is so massive that you got to get well ahead for like the profit margin to then justify itself later on. And it's just who's going to get there first.
I guess. I mean, like that's the thing that's wild is that we've not seen this with their existing businesses. You don't, and maybe we just didn't appreciate it because it wasn't happening in real time. Like I'm not an expert in how much Google had to spend on CapEx in order to become 98% market share in search, but it feels a bit different because you don't have these mega players all throwing tons of cash at the same problem, hoping to get a return on it. And, I don't know how much to believe of the recent reports that have come out to say, oh, companies aren't really seeing much of a return on their AI spend. And, we personally do tons of work at looking at different AI solutions. Some are very promising, some less so. Integrating them is challenging. Data security is challenging, but we're still early innings. So you don't want to completely write it off. But, the thought that if we're bringing it back to this idea of like, what do you trust? If the thought that AI is going to be the thing that makes the 150 basis points of margin expansion that's already contemplated in 2026 earnings, if that's going to be the thing that's going to deliver it, I don't know. I don't see it yet in boots on the ground, but I think that there's a lot of optimism that you will. And
it feels so much like the fiber build out. I just keep coming back to that. I mean, the only time in my career that this mirrors is like 1999 and Lucent and JDS Uniphase and WorldCom and everybody throwing fiber and technology in the ground as fast as the venture capital community would vomit money into those CapEx spends. And in the end of the day, most of those companies got absorbed, went bankrupt, their physical plants had to be sold to somebody else. Like, a lot of money got effectively thrown away, at the expense of investors who sort of lost out on the venture capital side because their bet didn't work out and somebody else's did. So it feels to me much more like that, where there's going to be some winners and losers, and all of this CapEx spend that's happened will advance the overall project of AI forward, just like all that fiber in the ground advanced the ubiquitous internet forward. But the ubiquitous internet winners were not JDS Uniphase. They were Google, right? They were Microsoft. They were Apple. They were these companies that we now look at and sort of say, yeah, remember when Microsoft said the internet was a fad? Like, and now they've got, Azure and run the backbone of the world alongside AWS. I don't know. Feels like it's really easy to call this as, well, they're all going to be hugely successful, and realize that half of them are going to get MySpaced.
I mean, it's almost like in the animal kingdom, if you want to be like the lazy bird riding on the back of the crocodile, right? The crocodile's doing all the work. He's doing everything, but you want to be the bird that's just sitting on top and being like, I want to go to from point A to point B. I want to do less work. And that's the question of who do the spoils of the productivity gains coming out of technology change, whether it's AI or the internet, who do those spoils accrue to?
I feel very strongly we're all getting this wrong, because I think the long-term answer is small and medium-sized businesses, not these giant companies where we're going to notice if their margins improve by 0.5%. No, it's going to be the sandwich shop chain in Iowa, right? That by using AI in their day-to-day life manages to be a company of 7 people instead of 13. And that's the difference between being viable and not. Like, that's where I actually think
$18 human on a sandwich yesterday. 18.
That's
human dollars on a sandwich, and it was a turkey sandwich. It's nothing fancy, nothing crazy, but I would love AI to bring some efficiency to the sandwich game.
Well, it might just preserve the margin on that turkey sandwich.
But seriously, that feels like, look, I mean, I'm now part of a small business. I joined ETF.com again 2 weeks ago. And, while I have issues about how AI might be replacing old jobs I used to have, like being a line writer, at the same time, I'm constantly looking around already being like, I can save 2 hours over there. I can save an hour and a half over there. That's a person I probably don't need to hire. Like, and those sound like cold clinical decisions, but every business manager in the world is making those same kinds of decisions. And I think it's easier for a small business to make those kinds of adjustments than a giant behemoth like KPMG or something to figure out how to get efficiency out of AI, right? You're going to spend $100 million on a project.
Yeah. Okay, two observations. One, that you're telling me that AI is coming for both Jared and sandwich artists, which is scary. Two, let's think about it from like the context of us as a smaller, more nimble RIA, right? We're able to adopt technology a lot faster, new technology a lot faster than big, huge legacy shops that manage trillions of dollars. And it's one of our competitive advantages because we're able to look at the landscape and say, we've built in this modern era a modular kind of plug and play where you can bring in new technology far more rapidly than in firms where I've worked in the past where the backbone screens of like how we access certain data look like the screens at the end of Ghost when he's trying to steal the money. You know what I'm talking about. That's what it looked like in 2010, right? So I think that to your point, you can, as a smaller firm, you can adopt these things more rapidly.
And it contributes to margin. It might not contribute to your public market multiple as somebody who's very sympathetic to the small RIA view, because this is the where I live in my day life. But it's like you have these little compartmentalized things, and you're regularly, we're taking 3 steps forward and 1 step backwards lately. Where it's like, oh, I can integrate these 3 things. They can all now talk to each other. We can have an agent that interacts between them. And these are huge productivity gains, but they would never translate at the other old firms I used to work for.
Right.
Like there's nobody's going to put that into place. So I'm hearing something inside of this, which is like, trust the realistic optimists. There's some type of optimism that we have to look for, whether it's a sandwich shop owner or maybe be cautious about your public market optimists or especially your private market optimists. We won't even go there. But all right, some trust is restored in the system and maybe some trust in self too. Dave, you got a topic?
Real quick one. So moving on, I have some friends that regularly move every couple of years just because of their job situation. So they have become in our friend group the moving experts. Like they save their boxes from when they move because they know they're going to have to move again. They know exactly which U-Haul is the good U-Haul, all that stuff. And one of the things they just sent a picture from their latest move is the last box. So literally after multiple truckloads, they take a picture and at the back of the U-Haul is one little square box that says the last box on it. And it's got, I believe, a bunch of like presents from friends and stuff that you're going to just be really happy to be like, oh, this is my teddy bear. Like all the stuff that's going to make a place feel better when you get there. And I thought that was such an interesting hack that only comes from experience. Like you have to move a lot of times before you realize that's just part of your routine to do that, not a one-shot thing that a friend came up with. And I was just thinking, we've been in the markets, we've been talking to investors most of our lives. What do you have that is like a little ritual, a little thing about how to manage your money, how to manage markets that's not something you're going to find in a textbook, but it's just like, you know what? At the end of the day, you do that, everything's a little bit better.
What do you got, Cameron?
Yeah, so I had the great fortune of one of my first portfolio managers that I ever worked for, a man by the name of Johnny Gibson, was a technical analyst. And a lot of people will, to use a line from LCD Sound System, like look at with spit and derision at technical analysis and say, it's astrology for chart watchers and et cetera. Except my horoscope today did tell me to drink more water, so cheers. But it's interesting because I love technical analysts like Jeff DeGraff and Chris Barone and John Roque. I think they're extraordinary. And what they do is they take the emotion out of things. And they add a dispassionate kind of approach to markets. And one of the things that I have built in, that whenever things get a little bit hairy, which, we haven't had many drawdowns of late, except for, earlier this year in April, is we have this, I built this, what I call a flush deck. And every time things get scary, I just run the flush deck. And the whole notion that people know is like, when we're running the flush deck and we start to hit these certain levels, I don't care how you feel. I have the book somewhere. It's my favorite book I have. It's Walter Deemer's When It Comes Time to Buy, You Won't Want to. And it's this idea of, okay, how do we get past that you won't want to point? And that's where the technicals come in. And that's sort of the last box, right? Of like, let's make sure that we have these things that allow us to overcome all of the fears and emotions that are inevitable when times get scary.
That's good.
There's a thing, and now, Cameron, you're making me think about this extra, and it might even tie into mine, but I'm going to hold that one back for just a minute. But it's like knowing how to end something. And I feel like I learned this from music personally, where it's like, you got to know how to end a song. You got to know how to end a set. You got to know how to end a performance. And that conclusion is as important as like the opening, because it's what you're going to send the people back out into the world with. And so it's less of a investment markets lesson, but even I had a conversation with clients this morning, and the source of the conversation was, we just found out our daughter's getting married. And we found out the daughter's getting married and we want to do a gift, but now we have to think about, where does it come from? How do we do it? What are the ramifications? It's a wedding it involves an international spouse. So it's like, there's a multi-part thing over like straddling 2 calendar years. So there's complicated real life stuff in this. But at the end of that conversation, before we hung up the phone and said goodbye, it was like, congratulations again. Like, we just had this whole conversation about taxes and crap and markets and like, are we really okay to do this? And does this change our plan to do this other thing? It's like, no. Okay. Like, congratulations again. We're going to stop and we're going to stick this part right back into where we started, which is, I'm so happy for your daughter and you're so happy. And how amazing is it that we get to now plot this gift?
That's awesome.
The last box, that last box sentiment of just remembering there is going to be a last part when you're going to put the bow on the end of this process. So like, why not just make it a good one? I think a lot of people overlook how to close the set, how to finish it off.
Yeah. Every musical needs a button, right?
Right. I love a powerful button.
Powerful button is the only way to go. No, that's really, really good. I feel like you stole the one that I was going to come back with a little bit. It's related, which is always say it out loud is the thing that I've learned. And it's particularly important if it's something that you would otherwise not say out loud. So I actually think I learned this from Brent Donnelly's Alpha Trader, fantastic book on like trading psychology. Yeah. And he has a whole thing in there, not just about a trade journal, which every trader talks about the importance of their trade journal. He has a thing in there about like standing in front of a mirror and reading out loud your trades and justifications. I am buying 500 shares of Qs at this price because I believe earnings will do this, right? If you say it out loud in a mirror and it sounds really ridiculous, that's probably telling you something. So
I feel like the idea of saying out loud, like these good things, like Matt, like I love that notion of sometimes we assume that we've already said it once, why say it again?
Mm-hmm. It's in there.
I used to dance for a woman named Pam Bowling, amazing dancer, amazing director, and she would require us in classes to yell and scream and cheer for each other. And there's something very fascinating that came out of that. Dancers are notoriously catty, notoriously fighting all of the time. Who's getting to be in the center? Who's the lead? Who's this? Who's that? There are always these like feelings of stress and strain within dance companies. We never fought. Our casts, and this is casts spanning over a decade, we never fought. Why? Because we were forced. We did it by choice. To yell and scream. If we weren't yelling and screaming loud enough for people, then she was yelling and screaming at us to yell and scream louder. I think that there's something in thinking about team building, but also with clients of like really acknowledging when good work has been done. Because it makes you more resilient to tough times when they inevitably come.
I feel like it goes the other way too, that it's important to be open and articulate when there is a problem, right?
But
Because
pair that with the flush
that
deck.
could be a real
Pair
issue.
that with the flush deck. That's
Yeah.
the confidence of saying, nope, here's the playbook. Everything sucks right now. Let's be honest about how much this sucks. And what she said before.
It's important to say the bad stuff out too if the alternative is pretending it didn't happen, because we see a lot of
Yes.
that. And I've talked to a lot of advisors who have struggled with that. I mean, every advisor has that conversation. The market's down 15% and my phone is ringing. Like, that does happen. And that can be a real struggle for some advisors. I know the first time they have to sit here and say, yeah, we're down 14% in your portfolio this quarter. Let's talk about that. That can be really hard and really easy to gloss over.
And the emotional toll.
Is power.
Yeah, absolutely. And the confidence to be proactive, which is also that agency and that confidence that's both learned and earned, right?
Mm-hmm.
Like that stuff that's hard.
You know, it's interesting. I talk with the team a lot about staying in this space of high humility, low hubris, because it's not to say you're not confident and that you don't know what you know, but hubris is a killer, right? Where you
Always.
overestimate how much you know and your confidence. And it has in order to have confidence, you also need to have the humility to know what you don't know. And so always like continuously going back to this idea of high humility, low hubris in all the decision making, I think it helps you be proactive. It helps you actually have the confidence to have those tough decisions or discussions.
All right, I'm using this to jump into my surprise topic of choice, partly because also now in my head I have Brent Donnelly standing in front of like a ballet bar mirror, listening to JPEG Mafia or whatever weird underground hip hop stuff. Have you heard this yet? Oh yeah, I've been on that for like months. How does this guy do it? All right, so I have an experience that I am still trying to process. While you were both going to see Nine Inch Nails, I was off at this music festival watching the great Robert Glasper, jazz, piano, hip hop, all this other stuff. So it's this festival. It's a 3-day event of like nonstop acts, 2 different sides of this giant venue, this resort venue out in California. So Robert Glasper's name is on the festival. Like he is the brand with Blue Note on this festival. I watched that guy for 3 days in the audience, on the side, like in the wings, and on the stage for I think every single act I saw. I have never, ever seen somebody do this to be like, he didn't miss an act. I didn't see one act where he didn't show up on the wings, taking pictures, taking selfies of himself, pulling the artist aside, coming out and sitting in, standing out in the audience. Like it was a next level lesson in like not just curating the person you are on the stage, but the person you are on off of the stage too. I don't see a lot of leaders doing it at that level right now. And I am just like emotionally obsessing over this idea of the on-stage person versus the side stage person and the in the audience person, and how you have to balance each. The humility and the hubris comes into this too. Because this guy could sit back and flex on a lot of Grammys right now across a lot of genres. He's not opening the LA Blue Note and then soon to be the London Blue Note with a residency and having this festival like for nothing. No artist was too small.
Without burning out.
I don't know. And maybe it was just a commitment for 3 days of being like, I have to get through this. What do you think? I mean, you both have arts and performance and other backgrounds on this. What do you make of that? Have you seen anybody do this before?
I'm trying to think if I've seen anybody do it in a business context.
Yeah, me too.
I've seen it at like fringe festivals for theater that are organized by a famous director, and they come out and they introduce every single play and then sit in the front row. So I've seen that in what I would call smaller, obviously self-supporting arts communities, which all fringe festivals pretty much are. Right? They're celebrations of people's weirdness, not commercial enterprises. And I see it more there in the theater. I'm trying to think if I've seen it in many business contexts, like people I've worked for or events that I've attended and things like that. And I'm not coming up with anything, which is really interesting because I think about big charismatic leaders from businesses that we, Benioff or Steve Jobs or whatever, people's names we would know. And it's like, nope, pretty much my only experiences of those people have been either as, very distant witness to a thing with them on stage or heavily artificially constructed social environments like this is the dinner where you get to meet, so-and-so or whatever, or, so-and-so is a friend and you get to go to their thing for half an hour, which are always they're not what you're talking about.
Yeah, they're
Do you guys have
performative in a
business
different
examples?
way.
I don't have any business examples.
I'm trying to even think about it in my own experience of how am I there for the people that I work with and being present. And that's why I asked the question of burnout, because we're all spread so thin. How do you be hyper present and still, without sounding too trite, of taking care of yourself and having some boundary and having rest time? Because maybe he can do that once because he's not as exhausted, but can he do that every year? Probably not.
I mean, unless it feeds you, right? I mean, I guess there's a bit of a personality activity match where if you manage to find yourself in that perfect situation where that is only required of you when you want to do it.
I think there's also a separate awareness there with him. And this is, I'm with you, because I was looking, Dave, for what are other examples of professionals in other domains where I see them show up. And maybe there's a couple where it's like, oh, it's a former CEO as like a podcast now, and he doesn't just talk to other CEOs or something. It's a couple of these little like micro examples of that.
I found one. I came up with one, and it's not even a big one. It's a somewhat obscure one. Jan van Eck. And I say this only because I've spent enough time with the Van Eck. Van Eck was my first consulting client for Cerulli Associates in 1991, right? So long relationship with him and his brother. And I've seen him over the years perpetually show up in places that surprise me. So like he runs the intern education program for Van Eck. So if you show up as the summer interns, like there's a little crew of 6 or 7 of them, one of the conditions is you have to sit through Jan van Eck's 1-on-6 education seminars every week, all summer long. He's teaching about the history of money, the role of gold in physical assets. Like he is teaching 1-to-1 these 20-year-olds that are coming in to like learn how to add things up in a spreadsheet. I've seen him consistently do that. He shows up at little conferences. He shows up in sales meetings that you would never expect him to be in. And always with that, not a sense of control, but a sense of like, hey, there's good work here going on. I want to support this. So, but boy, it took me 5 minutes to come up with one name.
You got anybody at all? And I really appreciate the showing up for your colleagues, because I think inside of that, and just so I was super excited. So partly we end up at this festival because I'm really bad. My personal inbox sometimes gets a little overwhelming, And so I'm a regular offender of I look and I realize there was a show or a concert or a thing that I missed a week ago. Like this happens constantly. And I had this running list of people I was constantly missing, and credit to my wife. She was like, okay, I'm going to start clocking the people you keep saying you're missing and then keeping track. And then like all of them ended up at this one festival. So we ended up going because she was like, I'd be a bad wife if I didn't force you to like go to this festival to see all the things you've missed in the last. Like, this is literally the list. I have it, proof, evidence. So one of the people who wasn't, I was like, oh, this is great. But because of course I'm now focused on the one person who's not going to be there. Like, well, Isaiah Sharkey's not going to be there. What a disappointment that Isaiah Sharkey, my guitar player, isn't going to be at this festival. So of course, who walks out on stage like the first day we're there in the background band? I'm like, that's Isaiah Sharkey. So Robert Glasper, he's going around, he's introducing this band for this like midday afternoon set on a Saturday. And like, he literally is like, you don't know who this guitar player is, a lot of you. This is Isaiah motherfucking Sharkey. He's like, you're going to realize why I call him Isaiah motherfucking Sharkey. And he proceeds to go, I'm going to feature him on a song. And then he proceeds to go and sit on like the edge of the stage and have a cigarette. Like not backstage, like literally like feet over the edge of the speakers, smoking a cigarette, watching it play. And I was like, what a nod of respect for this person to even put them in the band, not as a headlining spot, not as a named person, but then to go, even when they're performing, I'm going to watch you with the audience and just sit here and take this in.
Yeah, there's something to be learned there, for sure.
Showing up for our colleagues, like it was a next level lesson. I've been thinking about this a lot for my internal team, Cameron. Like, does that kind of like hit you too?
Yeah, I mean, that's the thing is like sometimes like bringing it back to the idea of like cheering for people. Sometimes your presence is the cheer. and how do you be present for people and see what they're what they're doing, and really, like Jan said, like, good work is here. Let's be here and see it. And compliments are good too, but having that engagement, I think, is really powerful. I mean, so David Ogilvy has a great quote, of course, like, famous.
A million great quotes, but
A
we'll
million
take
great
any one.
quotes, but one of my favorite ones is that he says, pay people more than you think that they're worth, because they will spend every day of their lives proving to you why they are worth that much. And there is an aspect of, like, pay is not just in the form of, like, monetary payment, but it's that how you feel, that rewardingness that comes from your work. And I think maybe a way to show people, that pay them more than they think that they're worth is your presence.
It's attention.
And
yeah.
And it's a big responsibility. But I think, you do that, like a whole team does that for each other. It doesn't just have to be leaders. I think that's a really powerful kind of cultural thing to build. So, yeah.
I agree.
All right, Cam, what do you got? I think you already gave us 3. Do
I
you want to
gave
pull
you
another
so
one?
many. Okay, so
Pull one out.
this is something that I've been doing a lot of thinking on, and it's an interesting week to do it, because on Tuesday, CNBC launched its new coverage of alternatives, which is really exciting. You're starting to bring these new strategies and make them available and to a broader audience, et cetera, et cetera. Great. And we've had a lot of public discussion and thoughts about the puts and takes within democratization of alternatives. But one of the things that we talk a lot about with clients is the idea of finding efficiency with both taxes and fees. And tax efficiency will tend to be in public markets of, like, where assets are located, and then at the same time making sure that if you're getting exposure to something, is it a tax efficient way of doing it, et cetera. Fee efficiency is really important when we think about alternatives, because it's know what you own and why you own it, and make sure if you're going to pay 2 and 20, you better be getting alpha, right? Because if you're just getting beta to something, it is not worth your extra fee. So think of things in fee budgeting, right? And making sure that what you are getting exposure to is actually worth the extra fee, because these things are very expensive. But I want to introduce, like, one more idea of efficiency, which I think that we overlook. And I think it's going to be really, really important for the industry, hopefully leaders in the industry, to discuss, which is this idea of hassle efficiency. Because as you start introducing more complexity into portfolios, you up the hassle factor significantly. And so you really need to make sure that if you are going to undertake the hassle of subscription documents and K1s and liquidity lockups and all of these things, that you are getting well compensated for it. Not taking on the hassle because it's sexy and everybody thinks you should be doing these things, but it gets you back to the Einstein quote. Things should be as simple as possible, but not simpler. And so it's like solving at every level of a portfolio. How can you take hassle out and find efficiency in these big 3 buckets, and finding ways to inject simplicity? Is this the right way to get exposure to this theme? And if the answer is yes, but it requires some hassle, then it's worth it. But if the answer is, well, I could actually replicate it, or I could get pretty close to this and it's a lot less hassle, it might be the right answer. And so that's where we're trying to think, as you see more and more of a push into these assets. I'd argue that a lot of the alphas will decay into click betas. Get it?
Got it. Received. Nicely done.
I think that it's something that can go awry really quickly if it's not handled with a lot of care, if that makes sense.
In both directions, though, no? Because, like, on the one hand, yes, I agree with everything you're saying, and I see a lot of advisors get attracted to shiny objects and not realizing that, oh, now I've complicated taxes and I've got to do one thing for every single client, every single quarter I wasn't doing before, or whatever it is. But the flip side of that's what's going on in the ETF industry, which is trying to take some of those kinds of alternative-like exposures, particularly any of them that involve the options market, because that's easy in ETFs now, and then package that all up and say, look, we gave you a single ticker. And then what you don't realize is under the hood, there's a percent disappearing in swap spreads, and your taxes are going to be a nightmare, and you're not getting the pattern of returns you thought you were. But there's enough smoke and mirrors that it looks simple, when in fact what you're doing is vomiting fees and slippage out the other side. So I feel like there's this trade-off that is almost unfair to expect advisors to navigate. Like, how are they supposed to know what is actually a nice, clean simplification and democratization of something that should never have been expensive versus a whole lot of smoke and mirrors to make you think you're getting secret access to the club when all you're doing is getting fleeced?
As simple as possible, but not simpler. And I think a lot of the ETF innovation has fallen into the simpler bucket.
Right.
It's made more simple than it should be.
Right.
I think we're looking for, and this is like professional hat on firmly for a second too, is clients asking, people looking for, where can I offsource this hassle to? I don't want to do it with the subscription documents, but if Mr. Advisor comes along or Mrs. Advisor and says like, I'll make private equity easy, great, we want to offsource it. And then if advisor turns around and goes, wait, this sucks, can I offsource this to a ETF provider? Great. And asking that benefits, the Wes Grayism that I always love on this is the benefits to brain damage ratio.
Yes. I love that.
What are the
Also,
benefits?
Wes.
Yeah, Wes is great, not just because he talks like a Ninja Turtle, but also because I've said this to him. We've reconciled this with each other. That is
Where you going, Ralph? To a movie.
amazing. Remind me to tell you offline about the time that
Sorry, I'm never going to get.
I sang Go Ninja Go to Vanilla Ice. It's a good story for that for another day.
I have a video of my dad on stage singing Go Ninja Go with Vanilla Ice. So
with him?
With him. Not to him, but with him.
Okay. It was a good experience on the stage, opening up. We were before him at like one of these outdoor college festivals. And we were like, wait, we're in the slot before Vanilla Ice goes on. So that means we're going to do like a whole synchronized Go Ninja Go routine before he comes on, because we're the last thing to do.
You took his...
You stole
he
his
only has
thunder.
2 songs. You took his second song.
That poor guy. I mean, I did have more respect for him after that, watching people just throw stuff at him the whole time. Because this is like early 2000s. This is before the reality show stuff, but also like I think life was just dark at that point.
Oh my god!
And he was getting hired as a novelty act, and so his thing was just like not.
I mean, what else is he going to get hired as?
It was
Look,
definitely
Ice
like
Baby
avoid
is the
this.
one and only song that I will do in karaoke. One and only.
Like, you know, it's one of those songs.
Will you do Vanilla Queen? Will you do the Under Pressure version?
I could do that. Actually,
The song is different. His song goes dun 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 dun.
Used had their big feud, and they stopped. You know, when the boys weren't fighting, and now the boys are fighting. They actually have a great cover of Under Pressure.
All right, this is one.
Check it out.
One for the comments. This idea, though, of like the benefits to brain damage ratio, of figuring out who you're outsourcing the complexity to, I think is one of the hardest parts for anybody who runs or works for an RIA right now. Because people are like, I have money, I have assets, make this easier for me and give me a lower fee to do this. And people like me are going, I really hope AI keeps making this easy, because the assets and the reporting and the data feeds are all getting way, way better. But there's not infinite margin there, and it is a lot of friggin' work.
They are getting better, but they're not great yet.
No, we got a long way to go.
There's so much manual work that goes into this, and you know, when we think about the the benefit, like you have to, these things are now table stakes, but it's a big undertaking in order to be able to do the due diligence and the operational work required to do it right.
And if you don't have the experience to know what right looks like before you jump in with one of these tools, and if you jump into one of these tools and they're a VC-backed tool that is only pricing their service in the way that they can do it because they have VC money that's flowing in, you get these rude awakenings along the way too, where you realize you're out of depth, or all of a sudden the costs go up, and now you've promised it to clients. Like, this is really tricky to navigate. All right,
yeah,
guys.
and I think people misunderestimate. That's a great word. Underestimate
They
underestimate the tax issues because they're
that is the
never as simple as you think they
miscongeniality
are.
of misunderestimation.
My misunderestimation of the tax complexity. Like, that's the thing that always seems to surprise people. Wait a minute. What do you mean this is not that?
All right, the big bow I'm putting on top of this is I really feel like who do you trust? You trust yourself. Like, that's the first and foremost thing.
And your friends.
And your friends. And then just benign skepticism for everything else, or a healthy amount of skepticism. Cameron, balance the hubris and the humility of the right amount of skepticism you should have for everything from ADP to BLS to corporate earnings.
Well, I think that we should be a lot like Sandra Bullock in Miss Congeniality.
Thank you. Bring it
where
back.
she had her name is Gracie Hart, or Gracie Lou Freebush, right? Gracie Lou Freebush. And that, like, she had, she had to believe in the cause, but she had to have skepticism of all of her other competitors. And remember when she thought the poor girl was the one who was the bomber person. So
terrorist.
I don't know, just be Gracie Lou Freebush, believe in the process, but have healthy skepticism. There you go.
There we
All
go.
right. The really important closing question now. Which Sandra Bullock movie character do you most closely identify with?
100% Miss
do we got one?
Congeniality. Come on.
What's her name on Speed? What's
You're
her name on Speed?
miscongenial. I was gonna say Speed is the one that where my brain goes.
I don't
We're going
remember the
with
name of the character she
miscongeniality?
plays.
I like the engagement too. The one where she's like in the field dancing with Betty White.
Oh, I don't think I've seen that one.
You've not seen it. It's classic. Watch
I
it
love
this
Betty
weekend.
White.
The engagement is, I believe, or yes, the proposal, the engagement, something like that.
The
Betty White's in it.
was it the proposal?
The proposal. Yes.
Okay, vaguely familiar.
Betty White is in it, and there's this epic scene where they're doing like some kind of dance in the woods, and it's just grade A Betty.
Grade A Betty. All right, so we got some Speed, we got some The Proposal, a little miscongeniality. Was she in Demolition Man? My brain's gonna be going on a bunch of these things now.
She could be.
We're gonna find out.
We
We'll
can't
Google
Google
that later.
anything,
We can't
apparently,
Google
so
it.
there is.
My brain's racking up the different random appearances. All right,
How
well,
wrong have we been about how many things?
Cameron, people want to bug you on the internet. Where should they find you these days?
I'm on LinkedIn. I'm on X. And I guess on Instagram. So you can find any of them. All of them. Oh, also you can sign up for our weekly notes on newagewealth.com. Or I believe it's newagewealth.com, but go to our website. And we've also started publishing now our Monday chart decks. So the team and I, we publish these great chart decks that go through a technical read of markets and what's coming up, and occasionally there's themes, like this week was Green Day with Wake Me Up When September Ends. So grab your guy liner, guys.
Grab your guy liner. Hey, listen. 2,000 light years away in slappy hours. We're
My
going
culture
on.
is not your costume.
Thank you. Definitely get those chart books and definitely get those weekly newsletters. I'm plugging those. MrETF.com, Dave Nadig.
Yeah,
ETF.
ETF.com is probably the best
For
place.
miscongeniality is definitely not Rain Man.
Definitely
not Rain Man. 323 toothpicks. Nadig.com
Cheese
for
balls.
weird stuff, ETF.com for normal stuff, and I'm Dave Nadig on all the socials.
Fantastic. This is Click Beta. This is Excess Returns, and we are out.
Thank you for tuning into this episode. If you found this discussion interesting and valuable, please subscribe on your favorite audio platform or on YouTube. You can also follow all the podcasts in the Excess Returns Network at excessreturnspod.com. If you have any feedback or questions, you can contact us at excessreturnspod@gmail.com.
No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of the firms of the hosts or their clients.